Okay, now let's talk about the character of the insurance industry, and it's interesting that currently the net data which we get on a daily basis for insurance investors, that's negative. And this is really the peak collection period for insurance companies. Yeah. Isn't there a strange dichotomy there?
See, you have to look at things from a longer term perspective. I told you last year insurance companies invested net about $12 billion. Our estimates are that this year that number could be around $15 billion, maybe even more. I think it's not correct to look at what's happened over the last 1 week, 2 weeks or thereabouts.
But this is again Puneet, the peak period. Peak period if they're selling.
That's okay, Nikunj. I think insurance investors are far more focused on things like valuation, far more focused on what's going to happen in the medium to long term rather than what's happening now. So let's say a union budget came. Obviously, it was a big positive. You know, they talk about cutting fiscal deficit down to 5.5%, focus on growth, so on and so forth. It has helped the market to rally a lot. Since the union budget has been announced, $3 billion of foreign money has come in. There will be some investors who would think that perhaps for their stocks that they had been holding in their portfolio, maybe the valuation levels have been reached, so they will sell. I don't think anything should be read into that. It is not unusual at all. I think you should see what happens at the end of the year and what is the net number for the full year.
What's your sense, the net number for the year, without getting into an absolute number, but give us a ballpark range for FY11 in terms of equity investments?
I think for this FY10 itself, the equity investments could be around $15 billion. And next year, depending on how the market conditions are, how the industry does, it could get closer to $20 billion.
So we're looking at $20 billion of net fresh inflow. This is fresh inflow which will come from insurance players like you.
It could happen provided things are on track, the market remains on track.
The $20 billion which you forecasted and which is the broader industry sense, is this more like a compulsive buying which will happen because $20 billion cannot stay on the sidelines, it needs to be invested?
I'm talking about the investable amount that will be, my guess is, maybe close to $20 billion. And it's not about compulsive. See, the fact is, in general, insurance companies do have net inflows every day. So in general, we would be net buyers. It's not necessary that we'll be net buyers every day, but if you look at monthly numbers, typically insurance companies would be net buyers. So I don't see any reason why money should not get into equity markets. Yeah, sometimes for a particular month, it may look like negative, so be it.
Characterize your current strategy for us in terms of how are you managing risk and how are you, dividing your portfolios?
See, let me take a step back and tell you what is the positioning of insurance industry in general. Insurance in India is sold as a long-term savings cum protection product. There are very strict regulations, so the minimum term of the product has to be, say, about 5 years or so. In general, it is sold as a much longer term product, so typically as a 10, 15, 20 year kind of product, number one. Number two, it is positioned as a goal-based savings product. So for example, most of the advertising that you will see from insurance companies will be about savings for child education, savings for pension, savings for certain goals. And when you introduce this element, people do tend to be a lot more disciplined than they would be if it was simply for, let's say, making money. So given this backdrop, the typical philosophy that an insurance company follows would be to invest for a longer term, and I know it's a very oft-used term, but I'll tell you what it really means. Any fund manager, whether it is an insurance fund manager or a mutual fund manager or a pension fund manager or even globally if it's a hedge fund manager, by the way, needs to have three objectives for their investors. You need to have the ability to generate returns, you need to have some sort of ability to stabilize the returns, and obviously there are customers who will look for some sort of safety. So these are the three objectives. I think the order varies. For an insurance company, and that's the way we pitch ourselves, the order is safety, stability, and then returns. We will try to give you good returns, but it will not be at the cost of undue risk. So that's the way we try to position ourselves. Within that, of course, we have very strict norms for asset allocation, we have very strict norms for sector exposure, very strict norms for company exposure. There are very strict regulatory norms, by the way. I think the insurance regulator in general has done a very good job by being both prudent as well as it has the ability and has actually demonstrated listening ability. So they do listen to us. At the same time, their main job is not just to develop the industry, also to protect the policyholder. So to that extent, I think it's a conservative philosophy that most of us follow, and that's the way we operate.